In today's video we will be learning what are capital gains. So, without wasting any time, let's get started. Imagine you buy something for $100, and later sell it for $150. You made $50 more than you originally paid. That extra $50 is called a capital gain. Capital gain equals selling price minus buying price. So, $150 to $100 equals $50 capital gain. In finance, things like stocks, ETFs, mutual funds, bonds, and real estate can increase or decrease in value. These are examples of investments that can create capital gains. Let's look at a simple stock example. Imagine you buy 10 shares of a company. Each share costs $20. You spend 10 times $20 equals $200. A few years later, each share is worth $35. Your investment is now worth 10 times $35 equals $350. If you sell all the shares, $350 to $200 equals $150 capital gain. You made $150 because your investment increased in value. Unrealized versus realized gain. There is an important difference. Suppose you bought a stock for $200, and it is now worth $350. You have a $150 unrealized gain because you haven't sold it yet. If you sell it for $350, the $150 becomes a realized capital gain. So, simply, investment goes up equals unrealized gain. Investment goes up plus you sell equals realized gain. What if the investment loses value? Capital gains can also go the other way. Suppose you buy something for $500, but sell it for $400. You lost $500 to $400 equals $100. This is called a capital loss. How can capital gains help you financially? Capital gains can help you grow your wealth over time. For example, you invest money in stocks or funds. If those investments increase in value over many years, your investment could become much larger. You could eventually use that money for things like buying a home, retirement, education, building savings, reaching financial independence. However, capital gains are not guaranteed. Investments can lose value too. What about taxes? Capital gains may be taxable when you sell an investment for a profit. The amount of tax can depend on factors such as how long you own the investment and your income. For example, U.S. taxes generally treat short-term and long-term capital gains differently. The easiest way to remember. Think about buying a toy. You buy it for $10. Later, someone pays you $15 for it. You made $5. That $5 is your capital gain. So, remember, buy, value increases, sell, profit equals capital gain. Capital gains are one important way investors can potentially grow their money and build wealth over time. If you enjoyed this video, don't forget to like, comment, and subscribe. Your support helps us create more useful content. Thank you.